Hello, Apriem family, and welcome to episode 19 of Apriem Financial Cents. Now, in this episode, we're actually picking up with part 2 of our 4-part series on what does a financial advisor do for me. And part 2 is all about the investment management piece of the puzzle, which I think is what most people think of when they think of the value or the benefit of working with a financial advisor. So I'm really excited about this particular episode. I speak with Kenneth Wolin, who is one of our senior portfolio administrators here at Apriem Advisors. He sits on the investment team, and we get to hear kind of all about his thoughts working here and where does he see that actual value come from. As far as the investment management piece goes. I hope you enjoy the episode. Thank you again for watching. Don't forget to like and subscribe to the channel.
So I can definitely say that from my role where I'm very client facing and I'm meeting with people often. It feels like, especially with new prospects, when people think about hiring a financial advisor, they pretty much only think that means, hey, if I let you manage my money, you're going to generate, what kind of return can you get me? Right, and that's not all that you really get when you're working with a financial advisor. But I think that what you guys do in your department is the number one thing that people think about when they think about hiring an advisor. Hey, you're going to manage my portfolio. Mm-hmm. What are the returns I can expect from being with you? Mm-hmm. So you've been here for how long? You've been with the firm now?
It'll be 3 years at the end of this year.
Okay, so you've been here for 3 years now. So you got a pretty darn good idea of what it is that we do, how we operate, and what we do for our clients. From your perspective now, having 3 years in, what do you think is the value of the investment management team for somebody coming in, a prospect, especially when that's kind of the sole focus of what most people think about? Mm-hmm. From your perspective being here now, what do you think are the big key value points that people get?
It's a good question. I think the value that we bring varies from person to person because I think of the services that we offer and that you help us deliver kind of varies from person to person depending on what they're looking for. You have some clients that are looking for growth and then some that are looking to just maintain their capital, and I think others may have more specific or complicated needs, and I think we're able to deliver on all of those. And so depending what we're trying to do, I think means different things to different people. And so I think that's the unique thing about our team because people just do think of the investments and what returns we can generate, which we absolutely try our best to do. Right. But I think it's, I guess it depends. It's a little bit more complicated in certain situations.
Yeah.
I think some of the key value adds also are the very nuanced and even I think the fine print that a lot of people maybe don't understand. There's a lot of jargon in the industry that I think that is complicated and I think makes the industry really intimidating. Right. And it I think can turn people off from what we do. It can be real easy to sound condescending when we're talking about certain topics and certain industries or sectors just because we're using language that I don't think people use every day. Right. And so that can just be in itself I think barrier for a lot of people to want to pursue it themselves or maybe create their own idea of what the industry is like. And so while we're not a Wall Street firm, we still do a lot of the things that I would say a Wall Street firm does in part. And so the value adds definitely are just making sure that you don't have to look at your portfolio every day, and we're doing that for you. Right. Making sure we understand the investment, in and out, what the fine print says, and some of these maybe products that are less transparent to the public. It's not like a cigarette box that says you can get a disease on these. They're not very explicit sometimes with all the rules and the inner workings of how this stuff works and how much you're paying for it, how much you're paying someone to pay someone for it. And so we try our best to be the fiduciaries for our clients to make sure that we're putting them in the best investments that we can find and also make sure that there's nothing fishy happening behind the scenes. And I think that's something that gets forgotten about from time to time.
Yeah, I think a lot of people think things like, well, if you're just buying funds, right? Can't I just go and put money in my I can go pick an S&P 500 index fund. Yeah. I can do that myself. Yeah. So what's the difference between having you do it and me just doing it on my own? And I think that some of those things that you mentioned are very relevant, right? How often are we really looking at what we're paying for? Mm-hmm. Could we be overpaying at one place, in comparison to another to get the same thing? Mm-hmm. And then I think that additionally on top of that, how much of a position weight should I be holding there? What is the focus of the fund? I mean, should it just be based on the market? Should it be international markets? Should it be holding emerging markets? And then which ones make sense? So I think that you kind of you really highlight the fact that there's lots of little things that are happening there that make it a bit more complex. Versus I guess in fact another way of thinking about it is that oftentimes they say, hey, what are you guys doing with individual stocks? Because an individual stock can sound really complicated and complex. We're looking at fundamentals and balance sheet, right?
Right.
Well, when we're looking at an ETF or a mutual fund, aren't there hundreds of individual companies that are in there?
Yeah, absolutely. I think, and it's a double-sided coin. You could pick an ETF and not have to pick the individual stocks that you own.
Yeah.
Or you could pick an ETF and know everything that's in it, and that's up to you. Or you can buy all the stocks yourself. And so, I guess that's a positive aspect of the industry is that the individual at the end, the retail client, has a lot of options available to them. But I think for that same reason, it can be overbearing and overwhelming, and you kind of don't know where to start. One of the value adds that we, I think, bring to the table is, as a RIA, we also have access to, I think, some institutional products that regular retail doesn't really have access to, or it's very expensive for them to get access to.
Sure.
And so either access to information or data is more at our fingertips, which allows us to communicate better with our clients and our team. And on the topic of communication, and I think this is something that your department and our department does pretty much hand in hand, is being able to speak on different topics, different themes, different trends that are going on, and we can give our opinion and we can share insight. And it's not necessarily to say something is right or wrong, or something should be something or should be another, but it allows us to, I think, be this shoulder for clients to lean on, to just know that they have someone to talk about with these topics. And I think a lot of the times there are things going on that we don't understand how they connect or related, and then we also don't know why maybe certain things are happening in the market, and we're allowed to, or we're able to give our 2 cents and maybe make that connection easier for the client to understand, ultimately maybe putting them at ease. Because part of your job and my job is to make sure that our clients can not worry about this stuff, that they can enjoy their life and not have to worry about managing their portfolio and thinking about, what is my stock doing, what is this manager doing, what is the management of this company doing with my net worth. And we're able to put clients at ease with our conversations so that they don't have to worry about it.
You said something that I think is very relevant, and that is there's things that they worry about. All right, and I think worry is really, really key, right? Because it gets you into the topic and the thought process of behavioral finance.
Absolutely.
Right, and markets are extremely, extremely emotional. And especially when our own money is in there and we're watching it, and sometimes it's either coming down or even when it's going up. It can be very emotional on both sides, right? When things are going up, we can get that fear of missing out. Should I be in there? Should I be in there? Why don't we have that? Why don't we have this? And then on the opposite side, when things are coming down, oftentimes questions, well, why are we still invested? Shouldn't we just sell it all and go to cash? And oftentimes that's not the right decision to make. And so on your guys' side, how are you guys approaching that emotional side? I know that, obviously we take what we do very seriously, but being able to remove those emotions from the decisions that you're making, how do you guys approach that?
That's a good question. It can be tough, but I'm glad you brought this up. I think behavioral finance is one of my favorite topics when it comes to the industry, just because I find it so fascinating. And it's true. It can be very emotional. I think watching your portfolio move up and down, any event in where maybe you have an accident, you have a large expense, that's a lot of money, that might give you some sort of like unease. And so when our team thinks about these things, it's somewhat systematic, because you have to be able to remove your emotions. Money shouldn't really be emotional, in my opinion, at the end of the day, especially when you are trying to generate growth from maybe yourself and your heirs as the time goes on. And so one thing we do is we have fixed position sizes, and so when something maybe goes beyond its weight, we can trim it back, and that prevents us from maybe being greedy in if something that is done well. If we have these systems and processes in place that tell us, hey, if this hits X threshold, got to bring it back to its way to bring it back to its
appropriate
weight. Yes, thank you.
Yeah.
And vice versa. I think when you maybe have too big of a position in something, it can be easy to let that really get into your psyche day in and day out.
Never want to let it go.
Right.
Never want to let it go. Oh, that's my one position that's doing really good. You always want to keep those big performance returns on there.
Yeah, and it can be dangerous. And it's funny. I like to think of Warren Buffett sometimes because I think a lot of people think of him as an advocate of diversification, and he's not necessarily an advocate of himself because I think he's a very, very wise investor. But for the average investor, he says that diversification is very important because it protects them from themselves. It's very often that an individual may buy an investment or buy a couple investments and they don't size them properly. Maybe it's too big in a portfolio. Maybe it's too small and they feel like they can buy more. And not understanding the size of how to put something in your portfolio can leave you to the whims of the market. And if something is too big, you might feel that you are overexposed.
Right.
And then in the same instance, you might feel underexposed and you might put more money in the market than you should.
Sure.
And what Warren Buffett is getting at is that investors can be almost a danger to themselves by not being diversified in a way that protects them in the event that they make a wrong decision.
Sure.
And so it's important for us to have these systems in place so where we take the emotion out of the portfolios and make sure that we follow a systematic process so that we know what's going in and going out and how we manage these things are done in a way that is fundamental but also detached from emotions. And it can be hard, especially in raging bull markets or what we experienced in 2020 and 2021. It can be pretty tough. You have a lot of different people calling and maybe your family's saying something, your friends are saying something, it's in the news, and especially when the news gets a hold of a theme and a narrative and continues to, I think, push it forward, you can really see it kind of broaden out into retail, and it reflected maybe even the prices of stocks in these volatile times. And so it can be a very tough thing to manage, but for our own team, it's something that we try very hard to detach ourselves from. Yeah.
I think it's really, really important to stick to a process, to stick to the plan over the long, especially during periods of time when you're either underperforming or outperforming the broad market. In both situations, it's easy to make bad decisions. Right? Because we either want to, hey, we're underperforming, so we need to jump into that, but that might have already run its course, and then we're lagging behind.
Right.
And it's almost like when you're driving on the freeway and you see one lane that's speeding, and then you get over, right? The minute you get over, the lane that you were in all of a sudden starts to go.
That's the
right?
worst feeling.
Yeah, it is. It's the worst feeling, but that can happen with stocks as well, right? Or just investments in general. And so it's very, very important that you find an appropriate allocation for somebody's risk tolerance levels, right? We stick to it. And then, like you said, when a position size maybe gets too large, that's when we take some profits, scale back, right? And then oftentimes those profits you can take and dump them in to something that maybe has come down and the position size has now gotten too small. But we still like that position. We still have faith in whoever that business is. And so that's rebalancing, and that's that opportunity when hey, this ran, so I'm buying something that's up, right? And, hey, this fell, so I know that I'm taking those dollars and I'm buying something that's low, right? And I think it helps give us that opportunity to get in a good habit there. But that's kind of the only way you can do it is when you've got a good process, you stick to the process, you stick to the plan.
Yeah, there's this, one thing I'd like to add, there's this saying, and I don't know who says it, but what they say is it's not the strategy that beats the market every year, it's the one that you can live with that allows you to, reach your goals. And I like that saying a lot, and that's not word for word. It's
but it's something along those lines.
Yeah,
and credit to the person that said it.
Right.
We don't know who it is.
Paraphrasing very roughly. But I like it a lot because it's true. I think for a lot of what we're trying to achieve and what I think you're trying to achieve with your clients is making sure that they stay invested. And it's not for our benefit, it's for theirs.
Yeah.
As we know, time in the market beats time in the market. Time is our most valuable asset, and it's one that we never get back. And so using your time correctly and appropriately will ultimately lead, I think, us and our clients to their goals. And so I think when we talk about volatility and we talk about emotions, we have to sympathize with our clients and, the people that we work with, because even though we try to remove emotions as much from what we do, we are people and we do recognize these things and we feel them too. We just have to put a little bit more effort in suppressing them.
Right.
But when it comes to finding a strategy that works for you, ultimately that is a team objective. And if you can find a strategy that allows you to stay in the market during the tough times and stay in the market during great times, then ultimately I think everyone's better off in the end.
Right.
And so I think that's a really valuable, thing to take away from investing. It's not FOMO chasing and trying to find the biggest and best investments out there to make sure that you're not staying behind, but it's finding the strategy that works for you, that you're not up at night, stressed about and not stuck to your screen, staring at your portfolio every day. That's my job. I try to do that so that you don't have to.
I definitely have friends that I will spend time with where they've had some really good home runs.
Yeah.
They got something and they had a great return on it.
That's awesome.
But 5 years later, they're still talking about the same home run, right? And which is what happens. And it's almost like the tortoise and the hare. Like sometimes that the hare is way out there in front, but the tortoise just keeps plugging along and keeps going.
Yeah.
And I feel like removing these emotions, sticking to a strategy, and allowing the strategy to play out, that's the one where you get the returns and you get the results that was part of the plan to begin with over 10, 15, 20, 30 years is where you leave it alone and you don't look at this, at the short periods of time and make decisions, snap decisions in those short periods.
Yeah, absolutely. I think one of the most detrimental things is making a short-term decision that affects a long-term plan that you had.
Right.
If you have a long-term plan, it shouldn't really matter what happens in 1 month now or a week ago and whatnot. It's you made a long-term plan on purpose,
right.
And sticking to that probably will benefit you more than being rash and unreasonable.
And so I think this is where, in my opinion, a lot of that value add of having an investment manager manage your money. It's not every year the expectation is that we're gonna outperform the market, we're gonna hit the next whatever company name it is. Sometimes it's gonna be there and sometimes it's not, but it's that long-term trajectory over time. And I think that really when it comes down to it, markets are pretty efficient. Markets are pretty efficient. And so if you have a 60-40 balanced portfolio here, or you have a 60-40 balanced portfolio that's over there or down the street, maybe 1 year, company A is outperforming companies, B and C, and a couple years later, company B is outperforming companies A and C. But 30 years down the road, they're all probably pretty darn close if they had the same equity exposure and the same bond exposure and they rebalanced on a regular basis. Their returns are probably going to be pretty darn close to each other over a long extended period of time. And I think that the value add comes to working with somebody that can help keep you on course.
Absolutely.
Keep you on course, keep you from, hitting a landmine, right? Especially at a wrong time. Yeah. And if we can avoid those consistently over many, many, many years, I think that's where a lot of the value add from working with somebody comes from. It's like, I know I can go to the gym and I know what exercises to do and I know how to have good form and I know how to eat healthy. But man, it sure helps a lot when I've got a coach that is there that's telling me what to do and pushing me hard enough to make sure I'm getting a good workout. Yeah, I keep my hand, texting me, hey, what'd you eat today? Yeah. Right? And then also making sure I'm not going so hard that I hurt or injure myself. Right. And I think that's where having a personal trainer really comes into play, and I look a lot at working with an investment manager the same way, right? I'm handing it off. I mean, that's what I do with my money. You guys manage my money, right? Here, you guys do it. I'm not going to look at it. I'm going to go meet with people. I'm going to do my job. I'm going to talk to folks, and I think that's where I think a lot of the confidence should really come from.
Right. One thing I like to think of is we have interns currently, right, in our office, and I think when they come in, they're all excited to go with the investment team and okay, let's see what it's like in the movies, and they expect us to make some crazy trades, to have some ridiculous returns in our 5-hour day or whatever that the markets are open. And one thing I told them is look, if I knew what the market was going to do, and if I knew how to beat it every single day, I wouldn't have a job. And this industry wouldn't exist. And it's true. And to your comment about efficient markets, and while we do have some inefficiencies at times, we definitely try our best to keep our clients grounded.
Yeah.
Because I think that allows us to all work towards the same goals in tandem. And as long as we can do that in a way that meets everyone's expectations, I think we can continue to make good progress.
Yeah.